Kaiser Report. I'm Max Kaiser. Time now to turn to Andrew McGettigan, author of The Great University Gamble, Money, Markets, and the Future of Higher Education. Andrew, welcome to the Kaiser Report.
Thank you, Max. Thanks for the invitation.
It's great that you're on the show. We saw you the other day. We had you come in immediately because you've got some really interesting stuff here. You were responsible for breaking the story regarding the secret report for the coalition government regarding selling off the £40 billion in student loans.
Project Hero, yes.
Hero! Project Hero! Tell us about it.
Project Hero is the code name for a report that was commissioned by the government from Rothschild Bank. They appointed them sometime around May 2010, and the report ran for 18 months. It's basically a feasibility study into how to turn the outstanding student loan balances into an investment-grade product that could be sold in a kind of originate-to-distribute model.
Right, now these student loans, of course, going back a few years, if I remember correctly, they were sold to the public as being top-up fees, that the government just needed a few bob to cover the cost of education, and as we predicted, this would soon escalate, and now it's become multi-thousand pounds per student per year, and now, because the government is in a situation where they are outsourcing so much of what they do to bankers all the time. They're trying to package this £40 billion student loan package out to some investors. So here we have Rothschild Bank. They're saying, to make this attractive for outside investors, we want you to retroactively go back, break the contracts, and raise the interest on these loans, correct?
Well, originally the loans were only available for living costs, for maintenance, and in 1998, when they introduced the top-up fee, that was a means-tested £1,000 upfront fee. But in 2006, after a lot of shenanigans in Parliament, the Labour government got through a motion to raise the tuition fee to £3,000, but part of the deal was bringing that £3,000 tuition fee loan tuition fee into the loan package. So then from 2006, people were taking out loans for maintenance and for fees. And then obviously last September, we had some new change coming in where tuition fees go up to £9,000. And again, there's a loan to cover that. And all of this loan is currently backed by the state. So you've got people currently graduating with debts of around £17,000, £18,000 on average. In 2015, when this lot of people on the new package graduate, they're likely to have debts around £40,000. And the idea was always that if you developed a nice originate-to-distribute model, you could issue the loans and then immediately turn it into an investment product, and people would buy it, and you'd have it off the balance sheet. But that's been the problem.
But this is a common theme in this government, both sides of government, the Labour and the Conservatives. They have gone down the path of these PPI schemes, private-public initiatives, where they go into business with bankers. They construct projects where the risk of the project on the interest rate side is supposedly insulated from the government, but we find out because they've been missold derivatives or they've been missold these projects from bankers, they explode in the face of the government, and the taxpayer always ends up having to foot the bill. So here, once again, you've got an escalation of the fees that are required now by students as the whole idea of the welfare state in Britain collapses under the foot or jackboot of these banksters who are continually taking over the function of where you expect government to work. But once again, I want to return to this idea that the interest rates on these loans, according to the Rothschild report, they want to go back and retroactively raise them, right?
Well, the student loans are kind of complicated to set up, but basically there was a protection in primary legislation that determined that these would be low interest rate loans.
A cap.
And there would be a cap, and the cap was you would pay the higher of either RPI or bank base rate plus 1. Currently bank base rate plus 1 is 1.5, but RPI is 3.6, and the RPI that they'll be using for the next year will be 3.4, but the bank base rates will be lower for a while. So at the moment there's a 2.1 percentage point spread between those two different potential interest rates, and that's what investors don't like. They don't want to take on a product which is potentially delivering returns under inflation over the next 20, 30 years. These are loans with long lifetimes. The loans they're proposing to sell, in the end there is a write-off clause that if you have an outstanding balance when you retire, that outstanding balance is written off. We're talking about people who graduated in 2001. Potentially they're not looking at retirement until 2040s. So the people who are potentially buying this are looking at taking on something for a long time.
This involves central bank games, interest rate games, statistical games, and gaming the public. Because you're saying that is the lesser of two rates, base rate or RPI.
Yeah.
Now, first of all, RPI, they don't even quote anymore because it's higher.
Find on the website what RPI even is at the moment.
That's right.
Yeah.
So that's a statistical game. So it's higher than CPI, which now they use because RPI, which is the old figure, was tracking a little bit higher than the new CPI number, which is a false accounting of the inflationary trends in this country. They adjusted for the actual cost of stuff people buy on a daily basis. The true rate of inflation in this country is between 5.5% and 6%. That's been now proven statistically by folks who track this stuff, who are mirroring the shadow stats work that's done in the United States. And here you have the idea that inflation is something that an investor has to worry about, but something that the ordinary citizen doesn't have to worry about because of what? The base rate. The base rate is kept artificially...
protecting the graduates.
Yeah, kept artificially low, which is creating this Ponzi scheme in the UK and giving birth to George Osborne's Help to Buy Ponzi scheme, and now this attempt to sell off student loans, £40 billion worth of student loans.
The deal on the sale entails a long-term loss to the government. I mean, the Rothschild were pricing this debt at 63p in the pound of outstanding balance. Now, the Rothschild report is from November 2011, and at that time, the government thought the value of keeping the loans on books was 70p in the pound. So the 7p spread there. You know, you shift these loans off the book, brings down your public sector net debt finance figure. You get a bit of cash up front now, but in the long run, on the long-term life of these loans, you know, you've forgone an income stream.
You're locking in a loss.
Yeah.
So for decades.
In some senses, you have to question the economic numeracy of a decision like this, where the government has an even lower rate of borrowing than the potential purchasers, but in order to sell it, it then has to artificially reproduce that same interest rate for the buyers, and therefore takes on the loss itself.
Because the government and the consultants who work with the government think only in the next quarter.
Yeah.
So here you have four major consultancies. Yeah, short-termism, which is killing the economy. So they're selling the cow to buy the milk.
And if you look at the other asset sales like Northern Rock, Lloyd's, Post Office, all these things, there's all these sort of subsidies written in there.
Big losses.
Yeah.
And no way to pay them back because the economy is not growing.
Well, the other option there was...
Well, let me ask this. Yeah. Can the economy be expected to grow if this class of students graduating right now is graduating under the onus of huge debts that they're being told that they'll never have to pay off?
Well, you have to ask how much aggregate demand is being taken out of the system by that 9% over £16,000 repayment threshold for all graduates.
A tremendous amount of aggregate demand, because we know that all the interest costs for all these schemes, right, adds up to the double or almost 2.7 times the amount of money being saved by these artificially low interest rates on the other side of the ledger book from the mortgage owners.
Well, one of the things is there were two options on the table. One was to go and change the interest rates for borrowers, and so the individual borrowers would stay in the system for longer because it took them longer to erode their outstanding balances, so they would make additional repayments at the end. The other proposal that Rothschild were making is what they're calling a synthetic hedge, and this would be where the government would artificially replicate that change by it providing those cash streams rather than the individual borrowers. And again, because of the long lifetimes of these loans, what the government today is effectively saying is, we will sign a contract with you, the purchaser, but whoever's in government in 25, 30 years' time, they'll be the ones who pick up those cash flows and pay them to you. So again, it kicks the can down the road in a different way, whether it's taxpayer or individual borrower. And for some of these people, they're going to be graduates and taxpayers, so they may even be paying twice over in 30 years' time. I think we should just mention that although this is, sounds like a UK or England-specific problem in a certain extent, in America, where you have a different problem of student debt, they are looking to this scheme we have in England as a kind of solution to the student debt crisis you have over there.
Well, in America, they have Sallie Mae, which is effectively the Ginnie Mae, or the Fannie Mae, Freddie Mac of the student loan market. And they're bankrupt as well, and they're seeking a massive bailout. And everything goes back onto the central bank's balance sheet, whether it's the Bank of England's balance sheet went from £800 billion losses to over $3 trillion under Mervyn King. The Federal Reserve Bank in the United States has inherited now something upwards of $5 trillion worth of new debt in the last, 24 months or so. So this all comes back to the same kind of accounting fraud that we see endemic throughout the world. Now, what's the current default rate on the £40 billion in student loans, and what's the state of this, what's the default rate? Because that's one way to judge a loan book.
Well, this is why they're different loans. You can't actually default on them because they're income contingent. You pay, it's like a tax. You pay $9,000 over an earnings threshold in repayments. Then non-dischargeable in bankruptcy. You can't enter into individual voluntary arrangements to get out of them. And so in a sense, it's only death or disability that, has the balances written off, or this long-term write-off policy for people with the earliest loans when they reach retirement, for the last iteration of 25 years. And for this current generation who will be graduating 40,000 debt, that's a 30-year write-off. Now, that's why the government estimates at the moment for the new loans, it's going to lose 35p for every pound it lends. So this is not a, this is not a commercial operation. They only think they're going to get 75p back over 30 plus years. So people who are starting this September, their write-offs are going to occur in 2046. And the current official valuations is that 75p of that pound will come back. And
how is that different than indentured servitude?
Well, you have the policy write-off. So it's not, what you're indentured to is 9% over an earnings threshold. So the earnings
are collapsing because banksters and fraudsters are destroying the economy.
The report that came out yesterday from the student loan company, which relates to tax year 2011-12, suggested that there are 800,000 borrowers who are below the earnings threshold of £16,000 roughly, and £400,000 of the HMRC Her Majesty's Revenue and Custom has no record of them in employment. Now, total borrowers is about 4 million, and 1 million of them are still in the system, so they're not liable for repayment. So another 400,000 have already paid back what they borrowed. But here we've got 800,000 people who aren't paying back anything because the economy is tanking, and particularly those people who graduated in 2009, 2010, 2011. What we can see on their debts is they're increasing despite this low interest rate cap, because they're just not earning enough to pay back at the moment.
All right, well, I assume George Osborne is going to apply for a loan of Wonga at some point and pay 5,000% and claim that's somehow good for the economy. All right, we're out of time. Thanks so much for being on the Kaiser Report, Andrew Gettigan.
Thank you very much, Max.